Welcome to The Explainer. Today, we're cracking open the playbook of some really experienced traders. We've distilled a private conversation they had into a guide on how they think, how they win, and maybe most importantly, the one trap that can bring it all crashing down. So, how do successful traders really think? Well, forget the textbooks. Today, we're looking inside a rare, completely unfiltered live stream between two pros. Our goal here is to get at the philosophies that actually guide their decisions in the real world, when the pressure's on. Now, this was a free-flowing, hour-long chat. They were jumping all over the place, from market trends to personal mistakes, you name it. So what we did was we sifted through all of it and found a structure. And what came out were three core strategies, three distinct ways they look for opportunities. But, and this is a big but, it's not just about what to do. It's also about what not to do. Maybe the most powerful part of their whole conversation was this raw confession about a psychological trap that can derail even the most brilliant strategy. We'll get to that, but first, let's dive into the strategies. Okay, first up, lens number one, the psychology of numbers. Now, this first strategy isn't what you might expect. It's not about some complex algorithm or deep financial analysis. Nope, it's something much simpler and maybe even more powerful. It's all about human psychology and our strange fascination with big, round numbers. So one of the traders shared this simple rule of thumb that he's observed for years. He noticed that when a stock breaks through a major psychological barrier, think $100 or $500 for the very first time, it often acts like a starting gun for another 10% run-up. And he gave us a perfect recent example, a stock called GEV. After it finally crossed that $500 milestone, the 10% rule would have pointed you to $550. But the momentum was just so strong, it blew right past that target and surged all the way to $642. So why does this happen? Well, these round numbers act like magnets. They get noticed by everybody. Traders, algorithms that are programmed to spot these breakouts, they all pile in. And that collective action, well, it creates its own upward momentum. It's a pretty fascinating quirk of market psychology when you think about it. All right, so that psychological rule is a great short-term tactic, but this next strategy, betting on the future, builds on that. It shifts from just a number to a whole narrative. This is all about thesis-driven investing, where you're not just betting on a price, you're betting on a story. And the example they zeroed in on here was Robinhood. One of the traders is holding it for the long term, not because of some daily chart pattern, but because he believes in a story about how the company is poised to fundamentally disrupt the entire world of finance. So what's the growth engine here? Well, the thesis is built on a few huge disruptive moves. First, they hooked millions of young users with their Slick app. Then, they basically forced the entire industry into zero-commission trading. After that, they expanded into crypto. And the potential next chapter? Moving into the massive sports betting market, which could just completely transform their business. And the difference really becomes crystal clear when you put them side by side with a traditional broker. I mean, look at who they're targeting, and then look at the interest they pay you on uninvested cash. It's just a world of difference. They're built for a totally different generation, turning a brokerage account into an all-in-one financial hub. But here's the key, the discipline. This is not a buy-and-forget strategy. The trader was super clear. You hold the stock only as long as that core story stays intact. The minute the story breaks, say a huge competitor emerges or their growth just stalls, that's when you sell, no matter what the price is. So we've looked at momentum and we've looked at long-term stories. This third strategy, finding the bottom, totally flips the script. This is a classic contrarian play, a disciplined method for buying great companies that have just been beaten down, trying to catch that exact moment they turn around. And the trader laid out a very specific 4-step process for this. He doesn't just buy a stock because it's cheap. First, he watches quality stocks hit new 52-week lows. Second, he waits for the selling to get exhausted. Third, he looks for a little bounce, a sign of life, and then watches it stabilize, and only then does he get in. And always with a clear escape plan, a firm stop loss just below that new bottom. But here's the thing, and this is so crucial. Even with that clear strategy, he's the first to admit Nobody can perfectly call the bottom. That's why that stop loss is absolutely non-negotiable. It's the protection that makes sure a small, calculated loss doesn't spiral into a catastrophic one. Okay, so after laying out all these logical, disciplined strategies, the conversation took this really sharp, personal turn, and it revealed the single biggest threat to any trader's plan: their own emotion. They started talking about this beast, revenge trading. It's that gut-wrenching, emotional need to get even with a stock that just cost you money. It's that moment when your brain's logic centers just shut down, and this raw desire for payback completely takes over. And in this moment of just incredible honesty, one of the traders confessed to falling right into this trap. Not in the past, but like right now. It was such a powerful reminder that this can happen to anyone, no matter how much experience they have. So he revealed he was holding the stock Eli Lilly, and as it fell, his position went deep into the red by about $30,000. He was in a massive hole on a stock he had once really believed in. And this is the trap in action. Instead of cutting his losses, that frustration just took over. He placed a huge, high-risk options trade specifically to try and win that 30 grand back fast. And what happened? The trade went against him, and he just ended up compounding the damage, digging that hole even deeper. And this quote just reveals the whole conflict. It shows the total disconnect between his rational, expert mind and his emotional actions. He knew it was a bad trade. He would have told anyone else they were being an idiot for doing it. But in the heat of the moment, he did it anyway. So the ultimate takeaway ties everything together. The real lesson here is that a good strategy is totally useless without the discipline to manage your own psychology. You can have the best playbook in the world, but none of it matters if you can't control that emotional impulse to chase your losses. And that brings us to the final question, really one for you to think about. Because hearing a trader admit to a massive mistake is powerful, but reflecting on our own is how we truly learn. In the world of investing, the lessons that really stick are often the ones that cost us the most. That's the explainer.